Hello, my dear students. Welcome back to the revision series. Now, in this session, we are going to revise the SA 200 series of the standards. What we are going to revise in the session, 200 series of the standards we are going to discuss. And particularly when I specify the standards which we are about to discuss in the standard, so those are four standards: SA 240, SA 250. Then we are going to revise SA 260. Along with that, we are also going to revise SA 299. And the content of these standards you will be able to find in our material in the chapter General Auditing Principles and Auditors Responsibilities. So when you open this particular chapter from our material, you will be able to find all these four standards under 200 series, which are what? 240, 250, 260 and 299. All the four standards we are going to discuss. SA 240 is a standard which is going to talk about auditors' responsibilities relating to fraud. So it is mainly going to talk about the fraud and related matters. SA 250 is going to talk about what is auditor's responsibilities regarding compliance with the laws and regulations. SA 260 is going to talk about communications with those charged with governance, and SA 299 is going to talk about joint audit and its related matters. So that is what going to be the subject matter of all our discussion. And one more thing here, for the purpose of explanation of these standards, I'm going to make use of this charts. So I have prepared this interactive charts. I've already told you where you can find the material. So where you can find this charts also. So just visit our website www.fingansacademy.com. In the description also you'll be able to find the link. So in that website you have to go to the resources section. In that resources section you will be able to find all the resources whatever I am using here. So for these standards, instead of revising from the direct main material, I have prepared these kind of interactive charts. From these charts we will try to revise it. Okay. So my suggestion will be, first at least once you should have read the main material. So whatever this main material content is there, at least once you should have read that standard. After you are comfortable reading the content of the entire main material, then only you use these charts for the purpose of your revision. So these charts are meant for revision. These charts are not meant for first time preparation. So I will tell you what will happen when you rely completely only on this. See, today in the market, these things are very popular. So they say something like summary notes, summary charts, a lot of things you will be able to find it in the material. But what is a mistake? I'm not telling they are bad, they're good actually. But what is a mistake which most of the students will do is they read only from that summary material. They read only from the charts. They read only from that summaries. Then the problem will be you will not be able to present the answers in the examination. That is not a proper way of preparation. So what you should do is you should read the content from the main material. For revision purposes, you have to make use of the summary notes, charts, whatever it is. Use it for revision purposes, not for the main preparation. If you are going to prepare only from that summary notes and all, then you are going to face a lot of struggle in the examination. You will not be able to write the content. Clear, everybody? So now I will be revising. We will start our revision with SA 240. Sir, what does SA 240 deal about? As you could see, the title of the standard, it is talking about auditors' responsibilities relating to fraud in an audit of financial statements. So this standard is going to talk about, as an auditor, if you are conducting audit of some entity, in case if you came to know about any fraud, or if you have suspected any fraud, if you found any risk of material relating to fraud, as an auditor, what are the responsibilities you should fulfill? What are the obligations you have to fulfill? So as an auditor, whenever you are conducting audit of any client, if you came to know any fraud has taken place in the client, or you suspected any fraud, or there is a risk of material misstatement regarding fraud, as an auditor, what responsibilities you have to fulfill? That is what the standard is going to talk about. But first of all, we have to remember, we have to go back to our basics. See, in the introduction chapter, I have explained you what are the objectives of the auditor. There are two objectives of the auditor. So ultimately, auditor is required to express an opinion, and that opinion is required to be expressed regarding two things. Number one, whether financial statements are free from material misstatements, and whether financial statements are prepared as per applicable financial reporting framework. We all know this very long ago in Introduction to Audit. We have understood this. Now here, most important thing is financial statements should be free from material misstatements. Financial statement should not contain any material misstatements. And I was already told you the meaning of the term misstatement. What do you mean by misstatement? Misstatement means we have understood as any difference between amount classification, presentation, disclosure, which is there in the reported financial statements, and amount classification, presentation, disclosure required as per applicable financial reporting framework. Simply, if I have to put it, a mistake in the financial statements, we are going to call it as a misstatement. And a misstatement can, in the financial statements, A misstatement in the financial statements can happen either because of fraud also, or a misstatement in the financial statements can happen either because of error also. The misstatement in the financial statements can happen because of two reasons. It can either happen because of fraud or it can happen because of error. Sir, what is the differentiating factor between the two? As you all are aware, fraud is something which is done intentionally, knowingly, willfully. You know that you are committing wrong, but still if you are committing it, that we call it as fraud, intentional. Whereas error is something which is unintentional. Error is something which is what? Unintentional. So a misstatement in the financial statements can happen because of either fraud or error. But you tell me, which is a matter of more concern for the auditor? Regarding which misstatement auditor has to be more concerned about? So auditor has to be more concerned about fraud. See, both have the potential. Fraud and error both have the potential to cause a material misstatement in the financial statements. But as an auditor, you have to be more concerned, you have to more worry, you have to perform more procedures, you have to face a lot of struggle for identifying the fraud, because it is intentional. When someone is doing an act intentionally, no one will do it in such a way that they will get easily caught. They will take all the precautions, they will take all the measures to make sure that this fraud is not coming to anybody's notice. So since it is committed intentionally, it is always going to be damn difficult for the auditor to identify the fraud. So that's why, since a fraud is such a crucial matter, such a critical matter, such a difficult matter, ICA has given a dedicated standard. Okay, dear auditors, you don't worry. I'm going to give you guidance, what responsibilities you are required to fulfill, what procedures you have to follow, what techniques you have to follow, in which and all ways fraud can be committed. We will teach you, we will guide you. You can use the standard to fulfill your responsibilities. With that intention, SA 240 has been given. So now, having said that, let us directly go into the standard. First of all, what is the definition of the fraud? How can you define the term fraud? So the fraud has been defined something like this. Fraud is an intentional act. When something is done intentionally, fraud will always be done intentionally. It is not by mistake something is happening. When I say fraud, someone is doing it intentionally, knowingly. So it is an intentional act. It can be committed by one individual or more than one individual. Either one single person can commit a fraud, or different people can collude together. More than one individual can also collude together and then commit a fraud. Sir, who can be that individuals? You are telling fraud is an intentional act. It can be committed either by one or more individuals. Sir, who can be that individuals who can commit fraud? Those individuals who are committing this intentional act, they could be from management. They could be from those charged with governance. They could be from employees, or they could be from third parties. Either management can do the fraud, those charged with governance can do the fraud, or employees can do the fraud, or even third parties like debtors, creditors also can commit a fraud. Sometimes all these people can collude with each other and can commit a fraud. Management, those charged with governance, employees, third parties, all are colluding with each other, and then also they can commit a fraud. This is what happened in the case of so-called bigger scams in our country, like PNB scam. It happened because people at different levels have colluded with each other. So fraud is an intentional act. It can be committed by one or more individuals, and those individuals can be among management, those charged with governance, employees, or third parties. And it always involves the use of deception. When you are committing a fraud, you are using deception. Sir, what do you mean by deception? You are cheating. But by committing fraud, you are not doing any noble act. By doing fraud, you are cheating. It involves a use of deception. Sir, why we are cheating, sir? To obtain an unjust or illegal advantage. So you are committing that intentional act. You are cheating someone. Why? Because you want to get some illegal advantage. You want to get some unjust advantage. Unjust means for which you are not entitled to. You wanted to get some advantage, wrong advantage you want to get. So such an act, we call it as fraud. Such an act, we call it as what? Fraud. Clear, everybody? So this is what the definition of fraud. Come on, repeat everybody once again. Fraud is an intentional act committed by one or more individuals. Those individuals can be among management, those charged with governance, employees, third parties. It involves a use of deception and to obtain an unjust or illegal advantage. Now, so if you come to the next part, the next most important thing, let us talk about responsibility. Who is responsible for prevention and detection of fraud in the company? Let us take an example, Reliance Industries Limited. So there is a company, Reliance Industries Limited. Now, in this Reliance Industries Limited, who is responsible for preventing and detection of the fraud? Who is responsible for stopping the fraud from happening? Who is responsible to detect the fraud, if at all it happens? The standard also says the primary responsibility, the major responsibility, the first and foremost responsibility for prevention and detection of fraud rests with management and those charged with governance. Who is primarily responsible for ensuring prevention of frauds and detection of frauds? Management and those charged with governance. So then what is auditor's responsibility? See, nowhere the standard has told no standard has told auditor is responsible for prevention and detection of frauds. So even SA 200, the first and foremost standard also says the responsibility of auditor is to obtain reasonable assurance whether financial statements are free from material misstatements. And also we know that there are some inherent limitations of audit. The process of audit is suffering from some inherent limitations. No matter how effectively you do the audit, still there is a chance of some misstatements not getting detected. So auditor cannot be expected to prevent a fraud. Auditor will not be able to detect all kind of frauds also. The responsibility of the auditor is to obtain reasonable assurance whether financial statements are free from material misstatements or not. And because of some inherent limitations, auditor sometimes may not be able to find out a fraud also without his mistake. Now, whether auditor will be able to detect a fraud or not, it depends on so many factors. Whether auditor will be able. So if you see this point here, the auditor's ability to detect a fraud depends on various factors. Sir, what are the factors? Number one, it depends on skillfulness of the perpetrator. Skillfulness means the person whoever is committing the fraud, how much skillful he is. See, if the fraud is committed by a very skillful person, very talented person, then what will happen? It becomes very difficult for the auditor to detect. On the other hand, the fraud is committed by a useless fellow. He is not so skillful. The auditor can easily identify it. It also depends on frequency and extent of manipulation. How frequently the fraud is getting committed. If the fraud is getting committed very frequently, somewhere it will come in my sample, it will be easy for me to detect. It also depends on degree of collusion, whether one person is committing a fraud or group of persons colluded. If one individual is committing a fraud without collusion, it is easy to detect. If so many people are colluding with each other, it is very difficult to detect. It also depends on the relative size, how much amounts are getting manipulated. If a very bigger amount of fraud has committed, somehow it will get attention. If small, minute amount of frauds are getting happened, it becomes very difficult to detect. It also depends on seniority of the individuals involved. What is the seniority of the person whoever is committing a fraud? If the person committing the fraud is very senior person, it becomes very difficult. If he is a new person, somewhere he will go wrong, we can get easily caught. So whether auditor ability, that is whether auditor will be able to detect a fraud or not, it depends on all these factors like skillfulness of the perpetrator, frequency with which the fraud is getting committed, how much degree of collusion is involved, what is the size of the amounts which is getting manipulated, and also seniority of the individuals. So you have told all this, but when auditor will be held responsible? If the auditor is unable to find out a fraud, if the auditor is unable to detect a material misstatement resulting from fraud, will he always be punished? Will he always be held responsible? The answer is no. SA 240 says the auditor will be held responsible for non-detection of fraud only when it is purely because of negligence. So if you see this, the liability of the auditor for failure to detect a fraud exists only when such failure is clearly due to not exercising reasonable care and skill. That means if the auditor has acted in a negligent manner, that's why he was unable to find out. That's why he was unable to find out the fraud. Then he will be definitely held punishable. However, if the auditor has put all the effort, he was not negligent, he was sincere, he was honest, he did everything in his control, but still he is unable to find out the fraud, then he will not be punished. Now the doubt comes, so it is whose responsibility to prove? Whether he did the work in a careful manner or he was negligent while doing the audit, it is whose responsibility to prove? It is always and always auditor's responsibility to prove using audit documentation. Clear? So this is what regarding prevention and detection of fraud responsibility. Number one, primary responsibility is with management and those charged with governance. Summary of the auditor's responsibility is auditor will be held responsible only when he is unable to detect the fraud because of negligence. Now, sir, what is the objective of the auditor? Very simple. This standard SA 240 puts three objectives on the auditor. As an auditor, you are supposed to do three things. First of all, you should find out whether there is any risk of material misstatement due to fraud. Risk means you have to find out the probability first. By performing risk assessment procedures, you need to find out, is there any risk of material misstatement resulting from fraud? Is there any chance of happening of misstatement from fraud? So first you need to find out risk of material misstatement because of fraud while performing risk assessment procedures. In case if you find a risk of material misstatement regarding fraud by performing risk assessment procedures, then you need to perform further audit procedures and obtain sufficient and appropriate audit evidence. First thing, perform risk assessment procedures and find out whether there is a risk of material misstatement relating to fraud. Number two, in case if you found there is a possibility of risk of material misstatement of fraud, then you need to perform further audit procedures to obtain sufficient and appropriate audit evidence whether fraud has actually taken place or not. In case by performing the further audit procedures, if you have actually found out the fraud, if you have identified the fraud, if you have suspected the fraud, then you have to respond appropriately. Then you have to fulfill your reporting responsibilities. So three objectives: find out risk of material misstatement. If you find risk of material misstatement, try to obtain evidence by performing further audit procedures. By performing that procedures, if you have finally found out the fraud, respond appropriately, fulfill your reporting requirements. These three are the objectives of auditor. Next. And next thing, we can divide frauds into two categories. So the two different categories of the fraud are, one is fraudulent financial reporting and the other one is misappropriation of assets. What are the two kinds of frauds, guys? There are the two kinds of frauds are, number one, fraudulent financial reporting, and the other one is misappropriation of assets. So now what is fraudulent financial reporting? As I've already told you, financial reporting means the process of preparation and presentation of financial statements. Fraudulent financial reporting means what? If the management of the organization is preparing financial statements in such a way that they are giving a wrong picture by doing omissions from the financial statements, by misapplying the accounting policies. If the management is trying to convey wrong picture through the financial statements, that kind of fraud we are going to call it as fraudulent financial reporting. On the other hand, the next category of fraud is misappropriation of assets. Sir, what do you mean by misappropriation of assets? Misappropriation of assets refers to those kind of frauds in which there is a theft, damage or loss happening to the entity's assets. There is a theft, damage or loss happening to entity's assets. So in misappropriation of assets, it involves theft of an entity's assets, or even it could involve damage of an entity's assets. So in this manner, we can divide frauds into two categories. Number one, fraudulent financial reporting, those frauds in which management is trying to convey wrong picture through the financial statements. Assets are not getting damaged, but they are trying to convey a wrong picture in the financial statements. That we call it as fraudulent financial reporting. Another category of fraud, which we are going to call it as misappropriation of assets, where entities' assets are getting stolen, damaged, misused, etc. You tell me, in which kind of fraud always management involvement will be there? In the fraudulent financial reporting, management involvement always will be there. Whether without the management's involvement, fraudulent financial reporting is not going to happen. Because if the financial statements have to convey wrong position, that couldn't happen without the involvement of management. So always the top level management will be involved in the fraudulent financial reporting. Whereas misappropriation of assets, the stealing of the entity's assets and all, this is mainly conducted by employees and low level staff. So you tell me, which one is more difficult between fraud and error? Fraud is more difficult to detect. In the fraud also, between misappropriation of assets and fraudulent financial reporting, which one is more difficult to detect? Fraudulent financial reporting. Logic behind it, the top level management is involved in it. Next one. Next thing, what are the instances which induce the management or employees to commit a fraud? Sir, why management will commit fraud? What causes the management to commit fraud? For example, if the management is trying to commit a fraudulent financial reporting, if they want to convey a wrong picture to the financial statements, what causes them to do that? Similarly, if an employee wants to commit a misappropriation of assets, if the employee wants to steal the assets of the company, what causes that employee to do that? You take any fraud, be it fraudulent financial reporting or misappropriation of assets, for any fraud to happen, there are three instances which must be present. So what are the three factors because of which any fraud will happen? Number one, incentive or pressure. Number one is what? Incentive or pressure. If a management is committing a fraud, they might commit that fraud because they are under some pressure, or they find some incentive in committing the act. If an employee want to steal the assets, why he is stealing the assets? Either there will be pressure on him, might be because of financial obligations and all, or he finds some incentive. If he steals the assets, sells it outside of the company, he can make the benefit out of it. Incentive, reward. So first factor, for any fraud to happen, the first thing which should be present is there should be either incentive or pressure. Next one. See, having an incentive and pressure alone will not be enough. There should be an opportunity also. Like for example, an employee is having a lot of pressure to steal the assets of the company, but the company is having a strong system of internal control. Do you think fraud can happen? No. So there should be some opportunity, like a weakness in the internal control. So there should be incentive or pressure. That should be supported by a perceived opportunity, and these two alone will not be enough. For example, I am an employee, I have a strong pressure to commit a fraud. I find there is a weakness in the internal control also, but I have a very good attitude. I am unable to justify my wrongdoing. If I commit the theft of the asset, I will not be able to rationalize. I will not be able to justify. I have a very good attitude. Then also fraud will not happen. So the concluding factor, which is the final step, which induces a person to commit a fraud, is rationalization, attitude. You should have such a bad attitude to justify your wrongdoings. If you commit a wrong thing, you should not be able to justify it. If you are able to justify, then only you can commit a fraud. Able to understand? So that justification attitude also should be there. What should be there? That justification attitude, bad attitude also should be there for any fraud to happen. So you take any fraud, whether management fraud or employee fraud, for any fraud to happen, there should be three things which must be present. Either there should be incentive or pressure, and there should be an perceived opportunity, and there should be rationalization. There should be bad attitude to justify your wrongdoings. If these three things are present, then only any fraud can take place. Now coming to the next part, sir, you told fraudulent financial reporting. So fraudulent financial reporting means management will try to convey wrong picture through the financial statements. How the management can do it? There are different ways in which management can commit fraudulent financial reporting. So now they are addressing how fraudulent financial reporting may be committed by entities. So how they can do it? Number one, they can do manipulations. They can do falsification like forgeries and all. They can do alteration of the accounting records. They can manipulate the accounting records or even supporting documents. This is one way. Or they will do intentional omissions. Intentionally, they will omit some items from the books of accounts and financial statements. Like for example, they are omitting to create a provision to inflate their profits. Quite possible. Or intentionally, they will misapply accounting principles. Capital expenditure, they will treat it as revenue expenditure. Revenue expenditure, they will treat it as capital expenditure. Intentionally, they will misapply the accounting policies. And also, sometimes management themselves will override internal controls. As I have told, for fraudulent financial reporting to happen, management should be involved. So what management will do is, they will only implement internal control, but sometimes they themselves will violate the internal controls to commit that fraudulent financial reporting. So what are the different ways in which they can override the controls? So as you could see here, they can record fictitious journal entries, fake journal entries they can record, particularly close to the end of the accounting year. Or they will play with assumptions. Under provisioning, over provisioning, more depreciation, less depreciation, they can play with the assumptions like anything. Omitting, as usual, they can omit entries. Advancing or delaying recognition. Like future year expenses, they will recognize in the current year. Last year's expenses, they will not they will recognize in the current year. They can either advance recognition or delay the recognition. Or they can conceal the facts. They can hide the important facts from the shareholders. They will hide the contingent liabilities like pending cases and all. That is also fraudulent financial reporting only. Or they will intentionally engage in the complex transactions. They will engage in difficult transactions so that ordinary person cannot understand. If the ordinary person does not understand, they will not ask the questions. Next one. Or they can even alter records and terms relating to significant unusual transactions like related party transactions. So these are all the different ways in which the management can commit fraudulent financial reporting. Similarly, sir, how misappropriation of assets will be conducted? What are the different ways in which employees can commit misappropriation of assets? Number one, they can embezzle the receipts. Like a cashier is there. He's collecting the sales amount. He's collecting cash from cash sales. Instead of recording it in the books of accounts, he might manipulate it. Or they can steal physical assets or intellectual property. Stealing of inventory, stealing of fixed assets, stealing of stationery. They can steal the fixed assets. Or they are causing an entity to pay for goods and services not received. Nothing but employees submitting fictitious bills, fictitious vendors are getting created, actually expenses not incurred, fake bill was submitted to the company and causing the company to pay for that. Or even sometimes entities can use the company's assets for personal purposes also. So these are all the different ways in which misappropriation of assets can be accomplished. 4 ways they have told: embezzling receipts, stealing physical or intellectual properties, causing an entity to pay for goods and services by submitting fictitious bills or fake bills, and using the entity's assets for personal purposes. Clear? So what we have discussed in this standard till now, we have seen what is the meaning of the fraud, responsibility for prevention and detection of frauds, what is the objective of the auditor, what are the various types of fraud, and how these frauds can be committed. So this concept I will come at the end of the standard. So fraud risk factors I will talk about it later. Let us discuss various other things. See, as I have just now told you, the first objective of the auditor. What is the first objective of the auditor? To find out risk of material misstatement relating to fraud. So while performing risk assessment procedures, you need to identify, is there any risk of material misstatement related to fraud? Sir, how can I identify that risk of material misstatement related to fraud? The standard is telling a few steps here. Sir, what are that few steps? If you see here, when you are performing risk assessment procedures, when you are understanding entity and its environment, you should try to obtain information whether there is a risk of material misstatement due to fraud. How, sir? Number one, simply you have to go and inquire the management. What you should do? Go and inquire the management and others like those charged with governance, internal auditors. Go and inquire with them and ask them, sir, is there any fraud which has taken place during the year? First step, go and do the inquiry. Then second step, you understand how those charged with governance exercises oversight of management processes for identifying and responding to risk of fraud in the entity. Nothing but second thing, you need to understand what role those charged with governance is playing. What role those charged with governance is playing, how far they are verifying the management activities, what is the role in the organization, that you try to understand. Third one, we need to identify what kind of internal controls management has implemented to prevent that risk. So try to verify that internal controls. And even you find out, are there any unexpected relationships identified in performing analytical procedures? That means you try to perform analytical procedures, you try to study the relationship between financial and non-financial information, and you find out whether there are any huge deviations, like number of employees have increased, salary decreased. This is a huge variation. This also would give you a hint that there could be a fraud happening in the employee benefit expenses. So like this, the standard simply asks you to do 4 steps in order to identify whether there is any risk of material misstatement due to fraud. What are that 4 steps? Number 1, understand or do the inquiries of the management. Number 2, understand the role of those charged with governance, how frequently they are monitoring the management activities and all that you have to do. Third one, you need to verify what kind of internal controls are there. Number 4, perform analytical procedures and find out whether any unusual relationships are there. So by doing that 4 steps, you will try to identify whether there is any risk of material misstatement relating to fraud. And by performing that 4 procedures, if you came to know that there is a risk of material misstatement, now what you should do? You should respond to that risk of material misstatement. How you should respond to that risk? How you should respond to that risk of material misstatement? By performing further audit procedures. So you basically performed your risk assessment procedures to identify the risk. If you have identified the risk, then you have to respond appropriately by performing what? Further audit procedures. And I told you in the risk assessment chapter, risk of material misstatement can be at 2 levels. Risk of material misstatement at the financial statement level, risk of material misstatement at the assertion level. If the risk is having the potential to cause a misstatement in the entire financial statements, if the risk is having a potential to cause a misstatement in the entire financial statements, we call it as financial statement level risk. However, if the risk is having the potential to cause a misstatement in just 1 or 2 items, that we call it as assertion level risk. Just go back to risk assessment and internal control chapter. We discussed about this in a detailed manner. And between the risk of material misstatement at the financial statement level and at the assertion level, which the auditor has to concentrate more? The auditor has to concentrate more on risk of material misstatement at the financial statement level. Why? Because it is having a potential to cause a misstatement in the entire financial statements. So just go back and watch that risk assessment chapter. You will get more clarity. So after performing risk assessment procedures, you might find out risk of material misstatement at the financial statement level or risk of material misstatement at the assertion level. If you find that there is a risk of happening fraud and that risk is the risk at the financial statement level, that means auditor has to pay more attention to that. How you can tackle that? How you can tackle that is, if you find that risk of material misstatement is a financial statement level risk, you have to allocate your engagement team who is having a lot of skill and ability. Nothing but experienced individuals you have to allocate in that area. Why? Because there is a risk of happening fraud, that way at the financial statement level. So use the best staff in your team to that area. And also you have to particularly check the selection and application of accounting policies, particularly regarding subjective measurements and complex transactions. So you have to pay more attention to that provisions, assumptions, estimates. In that area, you have to pay more attention. And finally, incorporate an element of unpredictability to the extent possible. Try to do the surprise checks. What you should do? Surprise checks you have to do. So if you find risk of material misstatement, that too if the risk is at the financial statement level, these are 3 steps you have to follow. First, allocate the most skilled and talented resources in that area. Number 2, try to pay more attention for estimates and assumptions. Number 3, incorporate surprise checks. Whereas if you find a risk of material misstatement at the assertion level, then what you should do is simply you have to perform further audit procedures to address to that risk. That means you have to perform compliance procedures and substantive audit procedures in a normal way. And also, if at all you find that there's a requirement to change your nature, timing, and extent of audit procedures to obtain the best possible evidence, you have to change your nature, timing, and extent of audit procedures as you wish. So nothing but if you find risk at assertion level, we will plan our normal further audit procedures. If at all required, we may even revise our nature, timing, and extent of audit procedures to obtain the best possible evidence. Simply what they're trying to say is, when you do the comparative study, when you find financial statement level risk, you have to be more careful. If you find risk of material misstatement at the assertion level, do the normal further audit procedures. And also, audit procedures responsive to risk related to management override of the controls. See, as I've told you, management will always be in a dominant position to override the internal controls in the organization. Who will implement internal control? Management. Since management themselves have implemented internal control, they will also have the power to override the controls as well. Yes or no? So that's why you have to perform some procedures to make sure that management did not override the controls, because there is always a chance, since the management are the top people in the organization, they can always have a chance of committing the fraud. They will always have a chance of overriding the controls. So particularly with regard to this area, you need to perform some procedures to make sure that whether management has overridden any controls or not. So how you can do that? How you can do that is by testing the appropriateness of journal entries. You have to spend some amount of time for analyzing journal entries. Particularly accounting estimates you have to verify, like provisions and depreciation. These areas compulsorily you have to verify, and you should understand what is the business rationale, what is the logic for undertaking transactions which are outside the normal course of business. If you find any unusual transactions, you should find out what is the business logic for that. So this is what the third area. You should perform these audit procedures which are responsive to risk related to management overriding controls, to know whether management has overridden on controls or overridden the internal controls or not. Particularly, you need to perform these steps. You need to verify journal entries. You need to verify the accounting estimates. You should understand what is the business logic for unusual transactions. So this is how you will respond. Okay, right. So first, what you have done, risk assessment procedures you have performed. Then you have found out risk of material misstatement. In accordance with that risk, you have responded to that risk by performing further audit procedures. Now, by performing these above steps, you will obtain audit evidence. That audit evidence, what you should do, you should evaluate, you should analyze that audit evidence, whatever you have got, by performing the procedures which are responsive to risk of material misstatement. Guys, you have to understand the sequence here. First, we perform risk assessment procedures, identified the risk. Then we perform further audit procedures. By performing that further audit procedures, we get evidence. Now that evidence we have to analyze. So what steps we have to follow in analyzing evidence? For example, if you obtain evidence and that evidence indicates that there is a misstatement indicative of fraud. You performed audit procedures, you obtained evidence, and that evidence is indicating that there is a misstatement from fraud. Then what you should do? So in case if the auditor identifies a misstatement, the auditor should evaluate first whether it is indicative of fraud. Is the misstatement is because of fraud? That you have to analyze. Yes, if there is such an indication, yes, the misstatement has happened and that is because of fraud. Now what you should do is evaluate implications of the misstatement on other aspects of the audit. So you found a misstatement and you came to know that, for example, you are verifying purchases. In the purchases, you came to know that there is a misstatement, and you came to know that that misstatement is not an error, that is a fraud. Now you have to evaluate, if in the purchases area only there is a fraud, why can't there be a fraud in the sales? Why can't there be a fraud in expenses? Reevaluate. Once again, go deeper in other areas also and find out, is there a fraud in other areas? So if you obtain audit evidence and that evidence is indicating that there could be existence of fraud in one area, you have to evaluate its impact on other areas of the audit as well. Next one. Sir, you obtain audit evidence and that evidence is indicating that there is a fraud, and not just a fraud, there is a management involvement in the fraud. If you have obtained audit evidence and that evidence is clearly indicating, yes, there is a misstatement, and in that misstatement, who is involved? Management is involved. That indication is there on the basis of your evidence. What you should do now? Now what you should do is, so if you find there is a misstatement, that too, who is involved there? Management is involved. That misstatement could be material or could not be material, but you have to be very cautious. In case if the management is involved in the misstatement, whether that misstatement is material or not material doesn't matter. You have to be more focused here. Why, sir? Why? Because since the top level management is involved, you need to do certain things like reevaluate risk of material misstatement. Initially, you don't know that management is doing these kind of activities. You thought management are honest and you assessed the risk of material misstatement as low. You might have performed less audit procedures. But now you got to know what is the true nature of the management. So what you should do? You should perform more audit procedures. You should reassess the risk of material misstatement and increase your nature, timing, and extent of further audit procedures. Clear, everybody? So if you came to know there is a misstatement in which the management is involved, first you need to re-evaluate risk of material misstatement. Since you have reassessed the risk of material misstatement, make changes to your nature, timing, and extent of the audit procedures. And if conditions indicate that there is a collusion, and there is a further indication that there is a management involved in the fraud, not just a management, there is a collusion. So many people have colluded with each other. Then what you should do? Is you have to reconsider the reliability of evidence previously obtained. Now you got to know management colluded. Management colluded with the different people and committed a misstatement. What about the evidence you have obtained till now? Might be you need to recheck it once again, because whatever evidence you have obtained till now, in that also there could be fraud. So now you got to know. So go and recheck the evidence, whatever you have obtained till now. And if appropriate, even you can consider implications on the auditor's opinion. If those misstatements and all are material, even you can give modified opinions as well. That is what the meaning of considering the implications on auditor's opinion. Clear, everybody? So this is what you are supposed to do in case if your evidence indicates that there is a misstatement in which management is involved. And finally, you need to perform analytical procedures also at the end of the audit. Try to perform analytical procedures, try to study the relationship, try to compare that results of analytical procedures with the understanding whatever you have obtained. If you find any huge deviation, that also you try to analyze. Clear? Basically, they're asking you to perform analytical procedures also. So this is how you need to evaluate evidence. What if the evidence indicate there is a misstatement because of fraud? What if the evidence indicate there is a management involved in the misstatement? What you are supposed to do regarding analytical procedures. And then finally, sometimes because of fraud, the auditor might come across some circumstances in which he is unable to continue the engagement. Sometimes you might come across this. Some extreme circumstances auditor will come across, because of which he will think that because of this fraud, I don't feel it is suitable for me to continue the audit. It will be better if I withdraw from the audit. That kind of circumstances you can come across. You can fall into that dilemma. You are conducting audit, you came to know there is a fraud in that client company, and now you are in a confusion. Oh, this much bigger fraud happened, whether I should continue this engagement or should not continue this engagement. In such circumstances, what you do? In such circumstances, what you should do is first determine whether there is any professional and legal responsibility to report to the persons who made the audit appointment. If you are coming across these circumstances, first determine, is there any professional responsibility on you? Is there any legal responsibility on you to go and communicate this? Sir, I came across these and these circumstances. I am in a confusion now. Whoever has made your appointment, go and communicate with them. Sir, I am coming across these circumstances. And also, in some circumstances, you might be required to communicate to the regulatory authorities also. Like in the case of banks, if you come across those circumstances, you might be required to communicate with RBI. So like that, if you come across such extreme circumstances, determine whether there is any professional responsibility or legal responsibility to communicate those matters to the persons who have appointed you and also to regulatory authorities. After communication, determine, is it appropriate and permissible to withdraw. After communications also, matters are not getting resolved. Then determine, is it possible for you to withdraw? Yes, it is possible. If you want to withdraw, yes, withdraw. No one will stop you. Withdraw happily. So you withdraw from the audit, but fulfill some formalities. If you are withdrawing, discuss with the management and those charged with governance the reasons why you are withdrawing. And also determine whether there is any professional or legal responsibility to report these reasons to the persons who have appointed you or to the regulatory authorities. Like in the case of a company, if you are withdrawing, you have to communicate with ROC. So simply the summary is, in case if you come across exceptional circumstances where you are into dilemma, whether you should continue the audit or withdraw from the audit, no problem, but fulfill these responsibilities. And also you should obtain written representation from the management and those charged with governance. You have to obtain written agreement from the management and those charged with governance regarding which matter, sir? Regarding that they accept their responsibility for implementing internal control, and they have disclosed to the auditor all the risk of material misstatement which they have came to know about it. And they have also disclosed to the auditor if they have come across any fraud, and they have disclosed to the auditor their knowledge of any allegations of fraud or suspected fraud by employees, etc. Basically, whatever management has got to know about the fraud, everything they have communicated to the auditor. That written confirmation you get from them. Clear? Next. And finally, communication to management and those charged with governance. If after performing all the audit procedures, if you came to know about fraud, what you should do? You have to go and communicate that fraud to appropriate management on a timely basis. If you came to know about the fraud, what and all frauds you have came to know, that you have to go and communicate with the management. Along with that, you should also communicate with those charged with governance also. In case if you came to know management themselves have committed a fraud, then don't go and report to the management once again. Directly go and report to those charged with governance and discuss with them nature, timing and extent of audit procedures. Finally, the auditor shall also communicate any other matters related to fraud, not just the fraud. If any related matters with that fraud is there, that related matters also you have to go and communicate. Simply communicate with management, communicate with those charged with governance. If management themselves are involved, don't communicate with the management once again, directly go and communicate with those charged with governance. And then finally, in some circumstances, in addition to communicating with the management and those charged with governance, you might be required to communicate the fraud to regulatory and enforcement authorities also, like RBI and sometimes ED, sometimes some other regulatory authorities. In addition to communication with management and those charged with governance, you might be required to communicate with regulatory authorities. Not in all the cases. In some cases, if there is any requirement of law or regulation, then you should fulfill those requirements also. So that's what they say. The auditor shall determine the need to report the occurrence or suspicion of a suspicion to a party outside of the entity. Determine is there any requirement. Sometimes legal responsibilities will be there, which will override the confidentiality. You should not say, for example, if the Banking Regulation Act is saying, if you find any fraud in the course of audit, communicate to RBI. You cannot say, no, I have to maintain confidentiality. I will not communicate with the RBI. You can't say that. Legal responsibilities will override confidentiality. And in some cases, the auditor may have a duty to report to authorities like ED and all. In some cases, it will be there. In those circumstances, you have to fulfill that as well. In some clients, the requirements for reporting fraud may be subject to audit mandate or legal laws and regulations. If any such requirement exists, please go and communicate with that regulatory authorities also. And finally, you have to, whatever you have done regarding the fraud, you have to document it, like what risk of material misstatement you have identified, how you have responded, what further audit procedures you have performed, and how you have evaluated audit evidence, what communications you have done, to whom you have communicated, what is the manner of documentation. Nothing but whatever we have seen above in the standard, all that things you have to include in your documentation as well, that you can go through. So one part I have left from this standard, which is not suitable for revision, which is the concept of fraud risk factors. This I will give you a brief. You can refer to this summary on your own. So there is a small concept called fraud risk factors. Sir, what is fraud risk factor? See, as I have told, the fraud can be of two categories. One is a fraudulent financial reporting and the other one is misappropriation of assets. And I told you that any fraud can happen because of three reasons. One is incentive or pressure. There should be opportunity. There should be rationalization. Even for misappropriation of assets also, to happen misappropriation of assets, three things should be there. There should be incentive or pressure, there should be opportunity, there should be rationalization. Now what SA 240 is telling you, dear auditor, I will help you. The standard is trying to help out the auditor by giving you few examples of the circumstances that indicate, that give a hint to the auditor that there could be a fraud in the organization. What SA 240 is telling? Dear auditor, I will tell you few events or circumstances. If you come across these events or circumstances, that will be a hint that there is a possibility of happening of fraud. And those events or circumstances, the standard has given a name called fraud risk factors. Fraud risk factors. So that's what they say here. Fraud risk factors means those events or conditions that indicate there is an incentive to commit a fraud, that indicate there is a pressure to commit a fraud, or that indicate there is an opportunity for committing a fraud. Nothing but they have given some circumstances, like for example, you came to know that your client is having a high degree of competition and your client is having declining of margins. Your client's margins are declining. Now there is a clear indication that there is a pressure on the management for committing fraudulent financial reporting. Yes or no? Or you came to know that your client is involving in so many related party transactions. That is an indication that since there are related party transactions, there is an opportunity for the management to commit the fraudulent financial reporting. So like that, the standard has identified few events or circumstances which give a hint to the auditor that there could be a possibility of fraud in the company. And what SA 240 has done is, SA 240 has given fraud risk factors for misappropriation of assets separately, for fraudulent financial reporting separately. And under each category of fraud also, the SA 240 has identified those risk factors which indicate incentive or pressure, which indicate opportunity, which indicate rationalization. And for fraudulent financial reporting also, they have given separately fraud risk factors which indicate incentive or pressure for committing fraudulent financial reporting, which indicate opportunity for committing fraudulent financial reporting, which indicate a rationalization for committing fraudulent financial reporting. So SA 240 has given fraud risk factors for misappropriation of assets separately, for fraudulent financial reporting separately, and for each fraud category also they have given the factors which indicate incentive or pressure, opportunity or rationalization separately. So like this, they have given under total 6 categories. Under total 6 categories, they have given fraud risk factors. Like as you could see here, these are the examples of the fraud risk factors which indicate there is a possibility of fraudulent financial reporting. And here they have divided which factors indicate incentive or pressure for committing fraudulent financial reporting, which factors indicate opportunity for committing fraudulent financial reporting, which factors indicate attitude or rationalization for committing fraudulent financial reporting. Similarly, they have given fraud risk factors relating to misappropriation of assets, which indicate incentive or pressure for committing misappropriation, which indicate opportunity for committing misappropriation, which indicate an attitude for committing misappropriation. So like this, like that, if few examples are given here, there is no much concept here, only examples are there that you can refer from this summary. Clear everybody? So this is what regarding SA 240. With this, we are successfully done with SA 240 revision. Clear everyone? So since we are done with SA 240 revision, the next standard which we are going to take up is SA 250. So SA 250 is a standard which is going to talk about consideration of laws and regulations in an audit of the financial statements. So here also, first we will try to understand what does this standard talk about? What is the purpose of the standard? What is the objective of the standard? Like SA 240, we have seen SA 240 is a standard which is talking about auditors' responsibilities regarding fraud. Now, if you have paid close attention, SA 250 is going to talk about laws and regulations. SA 250 is going to talk about what? Laws and regulations. So what are the auditor's responsibilities regarding laws and regulations? And this SA 250 is going to talk about those laws and regulations which the client has to comply with. Those laws and regulations which who has to comply with, which the client has to comply with. Let me give you an example to make you understand. See, you are a practicing chartered accountant. You are appointed as auditor of Infosys. You are appointed as auditor of Infosys Limited. So Infosys Limited is your client and you are an auditor. Now, as we all know, every business, depending upon their legal form, depending upon the nature of business, depending upon the products which they are dealing with, depending upon their operations, there are numerous laws and regulations which a client has to comply with. Like if you take the example of this Infosys Limited, depending on the nature of the company, this Infosys company is required to comply with so many laws and regulations. Like number one, they are required to comply with the Companies Act. Since it is a company incorporated under Companies Act, they have to comply with the provisions of the Companies Act. And since they have employees, they have to comply with the PF Act. They have to comply with the Gratuity Act. They have to comply with the Income Tax Act. They have to comply with the GST Act. They have to comply with IT related laws, Information Technology Act they have to comply with. So like this, depending upon the nature of the client, every client will have numerous laws and regulations which they have to comply with. Similarly, if you take Reliance Industries Limited, since it is a manufacturing entity, they are also required to comply with the Companies Act. They are required to comply with Industries Act, Factories Act. Sorry, they are required to comply with the labor laws. They are required to comply with pollution-related laws and regulations. They are also required to comply with Income Tax Act, GST Act, PF Act, Gratuity Act. So, like that, depending upon the nature of the business, the client's legal form, and their legal structure, there are numerous laws and regulations which the clients have to comply with. If you are an auditor of the client, what are your responsibilities regarding these laws and regulations? What are auditors' responsibilities regarding the laws and regulations which the client has to comply with? So this standard does not talk about those laws and regulations which auditor has to comply with. This SA 250 actually talks about those laws and regulations which my client has to comply with. And as I've given you examples, depending upon legal form, depending upon nature of entity, there will be numerous laws and regulations which your client has to comply with. As an auditor, what is your responsibility regarding it? So first I will ask you one simple question. You tell me, it is whose primary responsibility to ensure compliance with all these laws and regulations? It is whose primary responsibility to detect any non-compliances? I'm asking you a simple question. It is whose primary responsibility to ensure that the operations of the business are conducted in accordance with laws and regulations? That is, it is whose responsibility to ensure the compliance with laws and regulations? Or if at all any non-compliance happened, it is whose responsibility to detect that non-compliances? The primary responsibility is always going to be the management and those charged with governance. So management and those charged with governance, they are collectively responsible for ensuring the compliance with the laws and regulations, and to detect the non-compliances, that primary responsibility is going to be with management, not auditor. Can we expect the auditor to ensure compliance with laws and regulations? Do you think is the auditor appointed to make sure that entity complies with all laws and regulations? The answer is no. Can we expect the auditor to ensure detection of all non-compliances? The answer is no. So we can't expect the auditor to ensure the compliance. We can't also expect the auditor to detect all kinds of non-compliances. So the auditor's objective is to obtain reasonable assurance whether financial statements are free from material misstatements. So it is not the primary responsibility to ensure compliance. It is not the responsibility to detect all non-compliances. Does that mean auditor should not be concerned about the laws and regulations and all? No. We can't say auditor has nothing to worry about laws and regulations. He need not check the compliances. We can't say that also. Auditor cannot completely ignore. We can't make the auditor fully responsible also. Then what are auditor's responsibilities? Sir, you are neither agreeing to, we are neither telling that auditor is fully responsible, you are neither telling auditor is not responsible. Then what is auditor's responsibility, sir? That responsibility SA 250 says. Okay, so the primary responsibility for ensuring compliance and detection is management. So then what about auditor's responsibility? Then what about auditor's responsibility? For the purpose of auditor's responsibility, laws and regulations are divided into two categories. For the purpose of auditor's responsibilities, the laws and regulations which are applicable to the client can be divided into two categories. Those laws and regulations which have a direct effect on amounts and disclosures in the financial statements. Those laws and regulations which have a direct effect on determination of amounts and disclosures in the financial statements. And other broad category, we call it as other laws and regulations. Other laws and regulations. So what is this? What are those laws and regulations which have direct effect on financial statements? What are those laws and regulations which do not have a direct effect on financial statements? Let us try to understand this in a deeper manner. If we understand the difference between type 1 and type 2, 50% of the standard will be over. So this I call it as type 1 laws and regulations. This I call it as type 2 laws and regulations. So what are type 1 laws and regulations? So they say those laws and regulations which have a direct effect, those laws which are going to directly affect the amounts and disclosures in my financial statements, they will fall under type 1. Can you give me a few examples of those laws and regulations which have a direct effect on my financial statements? Like for example, if you take Companies Act. Companies Act is a law which is going to have a direct effect on the financial statements. We are preparing financial statements as per Schedule 3. That Schedule 3 is given under Companies Act. Income Tax Act is also going to have a direct effect on my financial statements. That provision for income tax which you are going to create, that will be calculated as per Income Tax Act. GST Act is also an act which has a direct effect on financial statements. PF Act, that provision, that provident fund amount, gratuity amount, bonus amount, whatever you are calculating in the financial statements, they are directly determined by these laws. So these are the examples of type 1 laws which have a direct effect on determination of amounts and figures, amounts and disclosures in the financial statements. Whereas other laws and regulations are those laws and regulations which don't have direct effect on financial statements. They don't have direct effect on the financial statements. Even though they don't have direct effect on the financial statements, but still compliance with these laws is also required either to avoid penalties or which are fundamental to continue the business. Under other laws and regulations, those laws will come which do not have direct effect on the financial statements, but still compliance with that laws is also required. If you want to avoid penalties or if you don't comply with that laws, you will cease to continue the business. Example, if I have to say, pollution related laws. Pollution related laws. See, pollution related laws will not have a direct effect on my amounts and disclosures in the financial statements. But still entity has to comply with pollution laws. If they don't comply, what will happen? Either they have to pay huge penalties or sometimes their factories will get seized. Or child labor law. Child labor law. So child labor law is also one of the examples of the law which do not have direct effect on the financial statements, but still you have to comply with that child labor laws. Why? Because if you don't comply, what will happen? If you don't comply, either you have to pay a huge penalty or it is fundamental to continue your business. Or if you are a restaurant industry, food related laws and regulations. FCA norms, food related laws and regulations. So food related laws and regulations are also those laws which fall under other laws and regulations. They don't have direct effect on determination of figures and amounts in the financial statements, but still compliance is required. If you don't comply with it, either you have to pay a huge penalty or you will be required to close down your business. So like this, for the purpose of auditor's responsibilities, we divide laws and regulations into two categories: direct laws and those laws and regulations which have a direct effect on the financial statements, other laws and regulations. You tell me, using your common sense, let us ignore what the standard is telling. You apply your common sense and tell me regarding which laws and regulations the auditor has to be more concerned about. regarding which laws and regulations auditor has to be more concerned about. So obviously you will say, yes sir, auditor has to be more concerned about type 1 laws and regulations, those laws and regulations which have a direct effect on financial statements. Regarding that, auditor has to more worry about. Yes, 100% you are correct. So that's what standard also told. SA 250 told that regarding type 1 laws and regulations, auditor should obtain sufficient and appropriate audit evidence. That means you need to treat that direct loss and regulations as those as a normal item of the financial statement. You have to perform in-depth audit procedures like any other financial item, and you need to obtain sufficient and appropriate audit evidence regarding compliance with type 1 laws and regulations. You have to treat it like any other ordinary item of the financial statement, perform in-depth audit procedures, and try to obtain sufficient and appropriate audit evidence. Sir, what about type 2 laws and regulations? What about other laws and regulations? The standard told you need not perform in-depth audit procedures. You perform limited audit procedures or specified audit procedures also, you can say. What you can say? Specified audit procedures. So standard is telling we don't expect you to perform in-depth audit procedures regarding type 2 laws and regulations. Regarding other laws and regulations, we don't expect you to perform in-depth audit procedures. We will specify. We will give you some 2-3 specific audit procedures. If you do that, it will be enough. So perform specified audit procedures regarding type 2 laws. When it comes to type 1 laws which have a direct effect on the financial statements, you perform in-depth audit procedures and you try to obtain sufficient and appropriate audit evidence. Clear, everybody? Sir, what are that specified audit procedures? We will see it. What are the specified audit procedures? We will see it in the standard. Everybody till here comfortable with the concept? So what did we speak about? We spoke about what is the management responsibility, what is auditor's responsibility, and for the auditor's responsibility, laws and regulations are divided into 2 categories, and what is auditor's responsibility regarding each category we have seen. So if you see it here, first we have seen primary responsibility for ensuring compliance with laws and regulations. It is whose primary responsibility, guys? It is always the responsibility of management and those charged with the governance. They have the primary responsibility to ensure compliance with laws and regulations. In order to make sure that for the management to make sure that their organization is complying with laws and regulations, they will implement various policies and procedures. As I've told, management and those charged with governance, they are the primarily responsible for ensuring compliance. So the management and those charged with governance, they should have some policies in their organization to prevent the non-compliances or to detect the non-compliances. So what kind of policies generally management will implement in the organization to prevent non-compliances? So like here they have given few examples. The management should continuously monitor what are their legal requirements, which laws they have to comply. They should have a list ready, what laws and regulations they have to comply with, what operating procedures they have to follow to monitor that legal requirements. So they should have a list of all the legal requirements. They have to continuously monitor which laws and regulations they have to comply with. Then they should have proper system of internal control. They should also draft some internal control to make sure that their organization is complying with laws and regulations. Then they have to develop a code of conduct. Nothing but detailed policy should be there. A detailed code of conduct they have to establish. And you have to properly train your employees. You have to educate your employees what laws are applicable, how they have to comply. Train your employees. And in case if you find any employee is not doing their activities as per laws and regulation, you have to bring disciplinary mechanism also. You have to punish those employees. You have to remove those employees who are violating the laws and regulations. And if required, you have to engage legal advisors. That's why reputed companies all will have reputed lawyers. They will recruit the reputed lawyers. So engaging legal advisors. And also you have to maintain a register of all the laws and regulations and also a register of complaints. In large entities, what they can do is they will assign this function related to laws and regulations to internal audit function, or if there is audit committee, they will assign this a task to audit committee, or they will have a dedicated compliance department in the organization. So by implementing all these policies and procedures, management has to make sure that management along with those charged with governance, they have to make sure that their organization is complying with all laws and regulations. And as I've told, when it comes to auditor's responsibility, we can't expect the auditor to prevent non-compliances. We can't expect the auditor to detect all non-compliances. For the purpose of auditor's responsibilities, we can divide laws and regulations into 2 categories. What are they, guys? Laws and regulations having direct effect in financial statements on amounts and disclosures in the financial statements, and number 2, other laws and regulations. Those do not have a direct effect, but still compliance is required to avoid penalties and which are fundamental to continue the business. Clear? Once again, I'm telling you, this charts you have to use it for revision purposes. At least once you should read the content from the main material. Okay, we have seen what is auditor's responsibility, what is management responsibility. Now, what are the objectives of the auditor as per SA 250? As we have told, when it comes to category 1 laws and regulations, when it comes to those laws and regulations which have a direct effect on financial statements, the auditor should obtain the auditor should obtain sufficient appropriate audit evidence. As I've told regarding category 1 laws and regulations, since they have a direct effect on the financial statements, you are not given any privilege there. You have to perform in-depth audit procedures, obtain sufficient and appropriate audit evidence. Whereas when it comes to other laws and regulations, what is your responsibility? If you perform specified audit procedures, that will be enough. If you perform specified audit procedures, that will be enough. Sir, what are that specified audit procedures? We will see now. And by performing these procedures, if you find out any non-compliances, that is, when it comes to type 1 laws and regulations, you will perform in-depth audit procedures. When it comes to type 2 laws and regulations, you will perform specified audit procedures. By performing these things, if you find any non-compliances, you have to report appropriately. Sir, how to report it? That also we'll see it in a while. So 3 objectives: obtain sufficient and appropriate audit evidence regarding category 1, perform specified audit procedures regarding category 2, and by performing this, if you obtain sufficient and appropriate, if you obtain any non-compliances, if you found out any non-compliances, you have to respond appropriately, you have to report appropriately. How to report it? We will see it now. Sir, as an auditor, what audit procedures you are required to perform regarding laws and regulations? As an auditor, what responsibilities, what things you have to do with regard to checking the compliances with the laws and regulations? As usual, first, when you perform risk assessment procedures, as we all know, first audit procedure we are going to perform is a risk assessment procedure. In risk assessment procedure, what we do, we try to obtain an understanding of entity, we try to obtain an understanding of environment, we try to obtain an understanding of internal controls. So as a part of your risk assessment procedures, when you are trying to understand entity, environment and its internal control, you should also try to understand regulatory environment. So as a part of risk assessment procedures, you should also try to understand what kind of regulatory framework is applicable to your client, what industry they belong to, what kind of laws and regulations are applicable for them. So which kind of non-compliances could be there. So that also should be included in the risk assessment procedures. So that's what they say. As a part of risk assessment procedures, the auditor shall obtain general understanding of legal and regulatory framework, what laws and regulations are applicable for your client. You have to understand that, and you should also try to understand how the entity is complying, what processes your organization is trying to comply, trying to follow to make sure that they comply with that laws and regulations. So this should be included in my risk assessment procedures. And if you remember, in the objectives we have seen, when it comes to type 2 laws and regulations, you need to perform specified audit procedures. No, sir, what are that specified audit procedures? Here they are telling, sir, what are that limited audit procedures which we have to perform regarding other laws and regulations? Very simple. They say 3 simple steps: just to go and inquire with the management and those charged with governance. So go and inquire with the management and those charged with governance. Sir, did you comply with all the other laws and regulations or not? Number 2, inspect correspondence with relevant licensing or regulatory authority. Nothing but check whether you got any notices from the pollution board, whether you got any notices from the food department. So check whether any correspondence happened with the licensing and regulatory authorities. And also certain other laws and regulations may need particular attention. Some laws and regulations require more attention, like pollution laws, food laws require more attention. Pay more attention to that. So simple 3 specified audit procedures. What are the 3 specified audit procedures? Inquiring with the management and those charged with governance, inspecting the correspondence with licensing and regulatory authorities, pay attention to certain laws. So these 3 are the specified audit procedures which you need to perform regarding other laws and regulations. Whereas when it comes to category 1 laws and regulations, in-depth audit procedures you have to perform. So when it comes to audit procedures, first thing we have seen, as a part of risk assessment procedures, try to obtain understanding of regulatory framework and how the entity is complying. Perform specified audit procedures regarding type 2, that is other laws and regulations, and remain alert to instances of non-compliances. If you came across any circumstances which indicate that there could be non-compliance, you have to remain alert to that, and even you need to obtain written representations from the management. Ask the management to give a written confirmation that they have complied with all the laws and regulations. If at all non-compliance is there, they have informed that to the auditor. So ask the management to give a written confirmation as well. So these are basic audit procedure which auditor needs to perform regarding laws and regulations. And particularly when you identify or suspect a non-compliance, if at all, if you find out any non-compliance, if you suspect any non-compliance, then what you should do? These are general audit procedure. And particularly when you identify non-compliance or when you strongly suspect a non-compliance, what you do. So what you do is, if the auditor suspects non-compliance, then he shall obtain understanding of the nature of the act and circumstances. So what is that circumstances which is creating that non-compliance? Which act is creating that non-compliance? That you have to understand, and you need to obtain further information to evaluate what is the effect of that non-compliance on the financial statements. Is it have a material effect, or it is not having a material effect? Is it pervasive, not pervasive? You have to consider that effect. And finally, the auditor shall also discuss with management and those charged with governance. Whatever non-compliances you have identified, you have suspected, first go and discuss with management. If the management is not giving you proper information, then consider need to obtain legal advice. If you discussed regarding the non-compliance with the management and those charged with governance, if they give you complete information, well and good. Sometimes management and those charged with governance also will not be able to give complete information. Then what auditor should do? He should go and obtain the legal advice, go and consult some external reputed lawyer. And after considering all the information, then you have to consider what will be the effect on my auditor's opinion. Nothing but if external legal advisor also unable to give you any advice, that will be a case of non-availability of audit evidence, and depending upon what will be the possible effect of that non-availability of audit evidence, we have to modify. That is, we'll give either qualified or disclaimer. So particularly when you find out non-compliance or when you suspect non-compliance, what procedures you have to do? First, try to understand which act related to that non-compliances, which circumstances led to that non-compliances, try to obtain further information. Number 2, go and communicate with management and those charged with governance, get the required information. If the management or those charged with governance are unable to give you required information, try to obtain legal advice. If you are unable to get that legal advice also, try to consider the impact on the opinion. Clear? So after doing this, you will decide whether there is a non-compliance or not. So finally, after performing all these audit procedures, you will have observations. Now, depending on that observations, you will consider the impact on your opinion. See, there could be three circumstances. There could be three circumstances. First, I will talk about the opinion, how non-compliances will have an impact on the opinion. You obtained audit evidence and you came to know that all the laws and regulations are complied. You came to know that all the laws and regulations are complied. You performed all the audit procedures as said now, and you concluded there is no non-compliance. All the laws and regulations are complied with. The management is very good management. What you will do? Will you give unmodified opinion or modified opinion? There is no purpose of giving modified opinion here. We will happily go and give unmodified opinion. Okay. Second case, you have obtained audit evidence. You have concluded, you have obtained audit evidence that there is a non-compliance. Your client did not comply with some laws and regulations. You have a clear-cut evidence. You have a pakka evidence that your client has violated so-and-so law and regulation. Now what you will do? Directly modified? No. Standard says one more thing. If you find non-compliance, first you need to check whether it is adequately disclosed or not adequately disclosed. Adequately disclosed or not adequately disclosed. Which means I came to know that management has violated some law and regulation, but it was properly disclosed. It was adequately disclosed. What do you mean by adequately disclosed? So management violated some law and regulation. They did not hide it. Might be because of some mistake they violated some law and regulation. Because of that they have to pay some penalty, some consequences they have faced. Management is very honest. They did not hide anything. In the notes to accounts they have clearly explained why they have why that non-compliance happened, what consequences they have faced, what penalty they have paid, and even that penalty was also recognized in the statement of P&L. That is what the meaning of adequate disclosure. So management made a non-compliances, but they did not hide anything. Clearly, they have given the effect in the financial statements. They did not hide anything. Why non-compliance happened, what consequences they face, what penalty they have paid, everything clearly explained in the financial statements. Now you tell me, in that case, are the financial statement misleading or not misleading? They are not misleading because management given all the information. So that's why here also standard says no need to give modified opinion. You can give unmodified opinion because management did not hide anything. No, financial statements are giving true and fair view only. In case if the management not adequately disclosed, management violated some laws and regulations, but they are trying to hide it. You know there is a non-compliance, but management is not giving that information in the financial statements. You tell me, in that case, are the financial statements giving true and fair view? Financial statements are not giving true and fair view. You have to modify your opinion. And what kind of modification you will give? Since you have evidence, there is a non-compliance, and you know that it is not adequately disclosed. If the effect of that misstatement is, if the effect of that non-compliance is only material but not pervasive, you will give only qualified. If the effect of that non-compliance on the financial statements is material and also pervasive, you will give adverse, because this is a case of availability of audit evidence. Now, third case. First case, you have obtained audit evidence, all the laws and regulations are complied. Second case, you have obtained audit evidence that there is a non-compliance. Third case, auditor unable to obtain sufficient and appropriate audit evidence whether there is a compliance with the laws and regulations or not. Whether laws and regulations are complied or not, the auditor is unable to obtain audit evidence. Unable to obtain audit evidence. Then what you should do? Then also you have to give modified opinion. Since it is a case of non-availability of audit evidence, you will give either qualified or disclaimer. If the possible effect of that non-compliance is only material but not pervasive, you will give qualified. If you are unable to obtain audit evidence and the possible effect is material and also pervasive, you will give disclaimer of opinion. Clear, everybody? So this is what the impact which will be there on my auditor's opinion. So the same thing I have told here, reporting of identified or suspected non-compliances, how you have to report your non-compliance in the auditor's report. I have told, if the auditor concludes means audit evidence is available. So if the auditor concludes that the non-compliance has a material effect and has not been adequately reflected, that's what we have seen. If it is not adequately reflected, then only modify. If there is a non-compliance but it is adequately reflected, no need to modify. So you have concluded, you have evidence that there is a non-compliance, but it has not been adequately reflected, then the auditor shall give either qualified or adverse. If the auditor is unable to obtain sufficient appropriate audit evidence, then the auditor should give either qualified or disclaimer. So this is how you will report non-compliance in your opinion. In addition to that, you have to report whatever non-compliances you have found out with the those charged with garnets. So that's what they're telling. Before you modify your opinion, you should also communicate with management and those charged with garnets. So if you find any non-compliance which is committed by the management, you will go and report to those charged with garnets. Sir, if those charged with garnets themselves are involved in non-compliance, what we should do? If the management did the non-compliance, we go and report to those charged with garnets. Sir, what if the top level management themselves have done the non-compliance? Then what we will do? So if those charged with garnets themselves have involved in the non-compliance, determine whether there is any next higher level of authority. Generally, there will not be. If there is any next higher level of authority, you go and report. Sir, what if there is no next higher level of authority? Go and consider legal advice. Go and consult a lawyer. Ask him what should be done in that case. So that's what they say here. If the auditor believes that there is a non-compliance, go and communicate with those charged with garnets. If the auditor suspects that management or those charged with garnets themselves are involved in non-compliance, determine next higher level of authority. If it exists, generally it will not exist. Where no such higher authority exists and or they are not acting upon even after communication, then you have to go and obtain legal advice. So this is what regarding reporting non-compliances to those charged with garnets. And in addition to that, in some circumstances, you might be required to non-compliance to regulatory and enforcement authorities also. In some circumstances, you might have a legal obligation to go and report this non-compliance to regulatory authorities like ED, ROC, or banking to RBI. So these kind of authorities also you might be required to report if required. So determine whether any such responsibilities are there. If yes, fulfill that reporting requirements also. And whatever you have done regarding all this laws and regulations, what are your audit procedures, how you have identified the non-compliances, what evidence you have obtained, what communications you have done, everything has to be included in the audit documentation. That's all. Very simple standard. This is what regarding SA 250. So we are done with SA 240 and also we are done with SA 250. So we'll be beginning our discussion. We'll be commencing our discussion with SA 260, which is talking about communication with those charged with garnets. What is the title of SA 260? Communication with those charged with garnets. So from this title, let us try to derive what this standard is actually trying to achieve. What is the objective of this standard? What is the purpose of the standard? See, the purpose is there needs to be effective communication with those charged with garnets. Sir, who need to have effective communication with those charged with garnets? Auditor. So there is a requirement that there should be a proper communication happening between those charged with garnets and the auditor if audit has to happen effectively. If you want the audit has to happen in an effective manner, if you don't want to have trouble during the course of the audit, so there should be a proper communication between the auditor and those charged with garnets. And this standard is basically talking about the responsibility, the communication responsibilities of the auditor with those charged with garnets. So we have to first understand the objective of the standard. So SA 260 is putting some responsibilities on the auditor. They are suggesting certain matters which are required to be communicated mandatorily by the auditor with those charged with governance. If I put it in other way around, SA 260 is going to tell the efforts which auditor is required to put to make the communication effective between management and those charged with governance. See, SA 260 does not talk about the responsibilities of those charged with governance. Standards on auditing will be talking about the auditor's responsibility, not with the management and those charged with governance responsibilities. So SA 260 is going to tell us certain responsibilities, certain matters which the auditor has to communicate with those charged with governance, so that there will be effective communication happening between both the parties. And ultimately, if there is effective communication between the auditor and those charged with the governance, overall audit efficiency and effectiveness will get increased. So now we are going to discuss in the standard what are those matters which auditor is required to communicate with those charged with governance, what things he has to communicate, what should be the manner of communication, what responsibilities will be there in case of listed entities, what method of communication should be followed. So all that things we are going to discuss. So before we talk about communication requirements, first let us try to understand who are actually those charged with governance. Who will fall under this definition of those charged with governance? First, let us try to understand it. So the standard has defined the term those charged with governance as the persons or organizations with responsibility for overseeing strategic direction of the organization and obligations relating to accountability. Very, very important definition. So whom do we call as those charged with governance? Those people or those organizations within the entity who are having responsibility for overseeing strategic direction. Those who are responsible for supervising, those who are responsible for looking after the strategic direction. Sir, what is strategic direction? For example, every organization wants to grow. Now, what strategy they have to take for growing? Like, for example, what products the company has to deal with, whether they have to go for manufacturing or they have to go for outsourcing, or they have to, if they are making profits, what should be done to that profit? Should it be distributed among the shareholders or should it be reinvested back in the company? Able to understand? Or if they want to expand or they want to cut down, they want to do further investments or they have to dilute their investments. So like this, the overall strategic direction, taking the organization ahead, that crucial decision making responsibility, those people are having that responsibility of taking that crucial decision making, those who are having the responsibility for overseeing the strategic direction. And not just that, those who are having the obligations relating to accountability. Sir, what do you mean by accountability? So if someone goes wrong, if something goes wrong in the organization, who we are blaming? If something goes wrong in the organization, who we are blaming? So those persons who are having that responsibility for accountability, obligations relating to accountability, that people we call them as those charged with governance. Clear and comfortable, everybody? So the definition you have to remember, you have to reproduce the definition as it is. Those persons or organizations with the responsibility for overseeing strategic direction and who are having the obligations with regard to accountability. See, it is very difficult to identify those charged with governance, especially in the organizations like companies. In small organizations, like for example, in the case of sole proprietor or in the case of partnership firm, it is very easier to identify those charged with governance. For example, I will give you one simple example. Take, for example, I'm a sole proprietor. For example, I'm a sole proprietor. As a sole proprietor, I started a restaurant business. I'm the owner of this restaurant business. But since I'm not able to look after day-to-day operations, for example, if I have to run a restaurant, I have to make a decision regarding which dishes have to be cooked, or who should be the chef, and what kind of items are required to be served, what quality of ingredients I have to use, all the decisions I have to take. See, I'm the ultimate owner. But since I'm not, I will take all the decision, what products I have to sell, which cuisines I have to offer. So all the decisions will be taken by me. But since I will not be available all the time at the restaurant, I will not be able to execute that decisions. So what I have done is I have appointed a person, I have appointed an employee, gave him the role manager. Now this person will execute the responsibility. He will manage the staff. He will make sure that customer is satisfied. So all that responsibilities will be actually taken care by this manager. Now in this organization, being the owner of this restaurant, I will fall under those charged with governance. And this manager, since he is having the execution responsibility, since he is required to execute, actually he has to make the operations at the ground level, this person will fall under management definition. Now, why I am being the owner, why I am falling under those charged with governance is why? Because I am responsible for overseeing the strategic direction. So whether I have to open a new branch, whether I have to close the existing branch, should I add new products, should I not add new products, that decision is taken by whom? Being the manager myself. So I am looking after the strategic direction, and also I am responsible. I have to face the obligations relating to accountability. For example, if one customer ate the food in my restaurant and he became sick, so who will be ultimately punished? They will not punish this manager. Being the owner, they will come and punish me. So that means I have the responsibility relating to accountability also. I will be held the face. I will be made responsible if something goes wrong. So those people who are responsible for overseeing strategic direction and those people who are required to face the obligations relating to accountability, that person we call them as those charged with governance. Whereas those who are actually executing the operations, that we call them as the management. So generally in the companies, what will happen is it is very difficult to differentiate between those charged with governance and management. Why? Because in the company, if you take who are required to make the decision making, like investment decisions, dividend decisions, who will make that decisions? Board of directors. Board of directors. So generally the board of directors will fall under those charged with governance definition. But actually what will happen in most of the companies is these board of directors only will execute that decisions also. In most of the organizations, for example, if you take Reliance Industries Limited, there will be a team of 10 board of directors. The 10 board of directors will be those charged with governance. Now, each of the director will head one department. For example, one director will be heading the production department. One director will be heading the HR department. One director will be heading the operations department. One director will be CEO. So that means the people, the board of directors are only making the decisions. They are only executing the responsibilities as well. So in most of the companies, it is very difficult to differentiate between those charged with governance and management. Why? Because in the companies, both the roles will be played by board of directors only. So board of directors only will play the role of those charged with governance. They will only play the role of management as well. So in the case of companies, it is very difficult to differentiate. Why? Because in most of the organization, both the roles will be played by board of directors only. But we can easily identify the differentiation between those charged with governance and the management in case of small organizations like sole proprietor, partnership firms, etc. Clear? So, but whatever it is, one thing you have to make it clear, the definition you have to remember. All this you keep it aside, definition is very, very important. The persons or organizations with responsibility for overseeing strategic direction and who are responsible for obligations relating to accountability, those people in the organization, we call them as those charged with governance. Okay, we understood who are those charged with governance. So now what are the objectives of the auditor? So what auditor is supposed to do, or what are the responsibilities on the auditor as per SA 260? What matters auditor is required to communicate with those charged with governance? So what SA 260 is telling? So SA 260 says that as an auditor, you are required to communicate certain matters with those charged with governance, and these are mandatory. There are certain matters the auditor is required to communicate with those charged with governance, and those matters are given in the standard only, and the communication of these matters is mandatory. So what matters auditor is required to communicate with those charged with governance as per SA 260? Number one, he has to communicate with those charged with governance the responsibilities of the auditor. As an auditor, you have to go to those charged with governance and say, what are your responsibilities? Like you should say, sir, I am responsible only for expression of opinion, and I will not give any guarantee. So as an auditor, you are required to go and communicate with those charged with governance your responsibilities, and also you are required to communicate overview of planned scope and timing of the audit. You should not go and communicate the detailed plan. You should communicate just, you have to give an overview of overall plan and scope and timing of the audit. Like for example, sir, I will do the audit within 10 days. I will, we 15 people will come for the audit. Like that, a overview of overall plan and scope and timing of the audit you are supposed to communicate. So first matter which is required to be mandatorily communicated by the auditor with those charged with governance is what? Communication of auditor's responsibilities and also giving a overview of planned scope and timing of the audit. Number two, and whatever other information you feel relevant, if you feel some information is relevant for carrying on the audit, it is also your responsibility to obtain that relevant information from those charged with governance. And also whatever your observations are there arising from the audit, you have to communicate that timely observations with those charged with governance from the audit. Whatever your observations are there, even that observations also you are required to communicate with those charged with governance, that too on a timely basis. And as an auditor, you should always move ahead to promote an effective two-way communication. So as an auditor, you have to take that first step to promote a effective communication between the management and those charged with governance. So if they ask you what are the objectives of the auditor as per SA 260, these 4 points you are required to write: communication of responsibilities of auditor, and also overall planned scope and timing of the audit, provide obtaining relevant information from the those charged with governance. Whatever your observations are there, that you have to on a timely basis communicate with the those charged with governance. And as an auditor, you have to promote a effective two-way communication. Now, specifically, they talk about each and everything. See, in the objective, they are telling as an auditor, you are required to communicate with responsibilities of auditor. What specifically you will try to communicate? That I have explained it here in a detailed manner. And also, they are asking you to communicate overview of planned scope and timing. When it comes to planned scope and timing, what exactly you have to communicate? That I have added one more paragraph here. And you are required to communicate other matters. You are required to even communicate significant findings. As I have told, whatever your observations are there arising from the audit, that also you are required to communicate. So what specific findings you will communicate with those charged with governance? So everything I have given in a detailed manner. So nothing but in the objectives they told certain points you are required to communicate. What exactly you are required to communicate regarding that points, that we have elaborated in a detailed manner in this paragraph. So number one, as I have told, as an auditor, you are required to communicate what are your responsibilities. So what specifically you will say there? You will say that the auditor shall communicate that auditor is responsible only for expression of opinion. You have to tell them that, sir, I am responsible only for expression of opinion. And also you should say that just because appointment of auditor, the management and those charged with governance will not be relieved from their responsibilities. So you should even communicate that audit does not relieve management or those charged with governance of their responsibilities. So the meaning of this term is you have to communicate with those charged with governance, sir, as an auditor, my responsibility is to expression of opinion. Just because you have appointed as an auditor, your responsibilities will not come down, your management responsibilities will not come down. Like, for example, sir, you are appointing me as an auditor. Just because you have appointed me as an auditor, you can't expect me to prepare the financial statements. The management is still responsible for preparation of financial statements only. So just because you have appointed me as an auditor, neither your responsibilities nor your management responsibilities will be reduced or relieved. Your responsibilities will remain intact. So this is what specifically you have to communicate when I say you have to communicate the responsibilities of auditor. Number two, you are even required to communicate overview of planned scope and timing. No. So when I say you have to communicate planned scope and timing of the audit, what exactly you will communicate? So they say that discuss with those charged with governance only overview of planned scope and timing of audit, including communication of significant risk. What major risk we have identified? What is your overview of planned scope and timing? Once again, you have to remember, you should not discuss detailed plan and scope with those charged with governance. If you explain the detailed plan, what will happen? Whatever you are going to know, that those charged with governance will come to know, and they will take all the precautionary measures to make sure that you will not be able to find out any misstatement. So that's why you have to just communicate only overview, and whatever significant risk that you have identified, that also you have to communicate. And apart from that, I told whatever your observations are there, that also you are required to communicate. No. So what specific significant findings, what exact findings you will, what kind of findings you will communicate with those charged with governance? Like, for example, if you found any significant qualitative aspects, if you have any observations regarding accounting policies, so that you will try to communicate. Number two, inappropriateness of accounting policies. If you came to know that the management is following certain accounting policy, which is suitable as per applicable financial reporting framework, but that you are feeling it as inappropriate. Like, for example, client is following SLM method of depreciation. That is suitable. That is required as per applicable financial reporting framework. But the consumption pattern is not going to be uniform. So the machinery was, like I gave you example for fair presentation framework. The company is buying a plant and machinery, and the plant and machinery is of such a nature that it will exactly produce at a number of units. For that kind of plant and machinery, production units method will be more appropriate. But what the management is doing, as per the applicable financial reporting framework, they are following either SLM or WTV. So you found that whatever accounting policy your client is following, even though that is accepted as per applicable financial reporting framework, but that is inappropriate. If you have such observations, inappropriateness of accounting policies, that also you go and communicate. Similarly, if you are facing any significant difficulties during the course of audit, if you faced any significant difficulties, if certain areas are troubling for you, those matters also you can go and communicate with those charged with governance. And unless all of those charged with governance are involved in the management, that means if management and those charged with governance both are different parties, then whatever matters you have discussed with the management, that you discuss once again with those charged with governance, and whatever written representations that you have requested from the management, communicate with those charged with governance once again. But however, see, as I have told, in most of the organization, those charged with governance and management, both the roles will be played by same persons. So if those charged with governance and management are same, then you need not communicate these matters once again. Why? Because whatever matters you have communicated with the management, you need not communicate it once again with those charged with governance. Why? Because both are same. See, these are 2 points you are required to be communicated only when those charged with governance and management both are different parties. That is what the inference from this term, unless all of those charged with governance are involved in the management, which means if management and those charged with governance are both are two different persons, then you communicate whatever matters you have communicated with the management with those charged with governance once again, and whatever written representations you have requested from the management, that you ask it once again from the those charged with governance. If both are same, no need to do this part. Next one. And also you can communicate the circumstances that affect the form and content of the auditor's report. For example, if because of some reason you are modifying your opinion, if some matter you want to include it in the key audit matter paragraph, if some matter you want to include it in the emphasis of matter or other matter paragraph, that also you have to communicate with those charged with governance. These things we have seen in SA 700 series itself when we are discussing audit reporting chapter, and any other significant matter as per your professional judgment. So they might ask you a question, give a few examples of significant findings from the audit which auditor is required to communicate with those charged with governance. Then you are required to write this points. Clear? So what we have done till now, we have understood what is the meaning of those charged with governance, what are the objectives of SA 260, and specifically what matters you have to communicate regarding each of the objective, that also we have seen now. And the standard specifically says, in case if you are conducting audit of listed entities, in case specifically you are conducting audit of listed entities, in addition to the above matters, even you are required to communicate certain matters regarding auditor's independence also. Which means if you are conducting audit of unlisted entity, if you communicate these above matters, that will be enough. If you are conducting audit of unlisted entity, if you communicate these matters, it will be enough. But in case if you are conducting audit of listed entity, the above matters plus independence requirements also you are required to communicate. So what specifically I have to communicate in case of listed entity in addition to the above matters? So the auditor shall communicate with those charged with governance in case of listed entity, whether their engagement team or their firm or their network firm, whether everybody has complied with the ethical requirements or not. Your firm, your engagement team, your networking firms, everybody have complied with the ethical requirements or not, that you have to communicate. And in addition to that, you should also communicate any relationships that might affect the independence. And specifically, when I say relationships that might affect independence, you have to communicate with those charged with governance what kind of audit services you are providing, either yourself, your firm, or networking firm, what audit services you are providing. If you are providing any non-audit services like management consultancy, if any non-audit services are getting provided either by yourself or your networking firms, you have to communicate what non-audit services you are providing. And along with that, you should also communicate with them what fees you are charging for audit assignments and what fees you are charging for non-audit services. These things are specifically required to be communicated in case of listed entities. So once again, I'm telling you guys, in case if you are conducting audit of unlisted entity, only these things. In case if you are conducting audit of listed entity, this plus independence requirements, both you have to communicate. Clear? Next. Sir, what should be the communication process? How you have to communicate? In case if you are conducting audit of a listed entity, compulsorily you have to communicate in the writing. In case if you are conducting audit of a listed entity, the matters which you are required to communicate with those charged with governance, that must be communicated in writing. In case if you are conducting audit of unlisted entity, there you will be given an option to even communicate in oral also. In case if you feel oral communication is inadequate, then you have to give the communication in writing, which means which indirectly means in case of listed entity, you have to compulsorily do it in writing, no option. But in case of unlisted entity, if you want, you can do it in the oral way also. But in case if you feel oral communication will be inadequate, which will always be, we have to do it in the writing. Clear? But practically what will happen, both in case of listed entities and unlisted entities, always the communication will happen in written format only. Why? Because the proof is required. No, that you have communicated. That proof you will get it only when it is in written format. Clear? And whatever matters that you are communicating with those charged with governance, everything should be included as a part of your audit documentation. Clear and comfortable? So this is what regarding SA 260. So what matters are required to be communicated, what should be the communication process, and that matters which you have communicated should be included in the audit documentation as well. Clear? So with this we are done with SA 260. So now we will be revising the next standard, which is SA 299, which is talking about the concept of joint audit. Very simple standard, very small standard, we can wind up in no time. So let us try to revise what is this SA 299 about. So as from the title you can see, SA 299 is a standard which is talking about joint audit of the financial statements. First of all, what is the meaning of joint audit? First of all, what is the meaning of the joint audit? I will tell you meaning, then I will give you a few examples to make you understand what exactly is this joint audit. So joint audit means when more than one auditor, when more than one auditor is conducting audit of same entity for the same financial year and also having same scope of work, then we call such assignments as joint audit assignments. So when do we call an assignment as joint audit? When more than one auditor is getting appointed for the same entity for the same financial year and also they have the same scope of work, then we call such audit engagements as joint audit engagements. So this is what the meaning of the joint audit. Now let me give you a few examples. From that you are supposed to say whether the assignments are joint audit assignments or not. Take for example, there is a company X Limited. They have appointed a firm A, B, C and Co, a firm of chartered accountants as auditors, in which three partners are there, A, B and C. All the three are practicing chartered accountants. Can we call this assignment as joint audit? For a company, a firm was appointed in which more than one practicing chartered accountant partners are there. Can we call that assignment as joint audit? No. See, in a firm, there could be numerous partners, but you have appointed only one auditor. One audit firm has been appointed. So that's why this assignment, we can't call it as a joint audit assignment. So there is a company, X Limited, for the financial year 22-23, they have appointed ABC and Co, an audit firm, as a company auditor. For the financial year 2023-24, they have appointed another firm, XYZ and Co, as a company auditor. Can we call this as a joint audit? No, because for two different financial years, two auditors were appointed. This also we can't call it as joint audit. Same, X Limited, for the financial year 2023-24, they have appointed Mr. X, an individual practicing chartered accountant, as a tax auditor. They have appointed for the same financial year 2023-24, Mr. Y, another practicing chartered accountant, as a company auditor. Can we call this as a joint audit assignment? No. Why? Because here the scope is changing. One person is appointed as tax auditor, one person is appointed as company auditor. X Limited, the company, for the financial year 2023-24, they have appointed Mr. X, who is a principal auditor of the company. For the same financial year 2023-24, they have appointed another person, Mr. Y, another practicing chartered accountant, as a branch auditor for the same financial year. Can we call this assignment as a joint audit assignment? Here also the answer is no. Why? Because here also the scope is different. Principal auditor will have scope as entire company. Branch auditor will have a scope of only that specified branch for which he is appointed. So this also can't be called as joint audit assignment. X Limited, for the financial year 2023-24, they have appointed a firm ABC and Co as a company auditor, and for the financial year 23-24, another firm XYZ and Co, they have also been appointed as company auditor, and both the firms are signing the audit report. Can we call that as a joint audit assignment? Yes. Same entity, same financial year, same scope of work, more than one auditor appointed. This we can call it as a joint audit assignment. Or X Limited company, for the financial year 2023-24, they have appointed a firm ABC and Co, and for the same financial year, they have appointed another individual practicing chartered accountant, Mr. X. Both are conducting company audit. Both are signing the audit reports. Can we call it as a joint audit assignment? Yes. So when more than one auditor, when I say more than one auditor, more than one audit firm or more than one individual practicing chartered accountant or a combination of audit firm and individual practicing chartered accountant are appointed for the same financial year, for the same company, having the same scope of work, we call that assignment as joint audit assignments. So does the joint audits really happen? Yes, they do happen. When you open the Reliance Industries Limited audit report, you will be able to find the partners from two different firms would have signed the audit report. So let me show you here. Where are annual reports? Yes, here I have the annual reports. Shit, here it is not there. Yes, here is the audit report for Reliance Industries Limited. So if you see the audit report, at the end of this audit report, as you could see here, at the end of this audit report, as you could see here, two firms, partners from two firms would have signed the audit report. So here, I guess, where it is. Okay, so this is some another year. This, yes. Come on. Okay, yeah. See here. So this is the audit report of Reliance Industries Limited, and as you could see, there is one partner who is signing on behalf of the firm Deloitte Huskins and LLP. There is another partner who is signing the audit report on behalf of the firm Chaturvedi and Shah LLP. So for the same financial year, for the same company, for the same scope of work, two firms have been appointed, Deloitte and Chaturvedi and Shah. So the Reliance Industries Limited audit is a joint audit. Not just that, similarly, if you download the audit report of the SBI, you will be able to find this one. So if you download the audit report of the SBI, you will be able to find some partners from 14 audit firms who would have signed the audit report. That means 14 audit firms have been appointed as company auditors for the SBI, as a statutory auditor for the SBI, and the partners from all these 14 audit firms are signing the audit report. So like this, yes, joint audits do really happen, where more than one auditor is getting appointed for the same entity for the same financial year and also having same scope of work. But there is no mandatory requirement for the time being. Now joint audit is not mandatory, but in the coming future they can make that mandatory for certain large companies. But for the time being now, joint audit is not mandatory. It is completely voluntary decision of the client. If the Reliance would have appointed joint auditors, that is a company management's voluntary decision. If the SBI has appointed joint auditors, that is a voluntary decision of the SBI. So now a doubt will come, sir, why joint audit? What is the purpose of having the joint audit? Why an entity needs more than one auditor? Very simple. If you have joint auditors appointed, there are various advantages. Companies are finding huge advantages in appointment of joint auditors. Sir, what are the advantages? Number one, sharing of expertise. If you appoint more than one individual or one audit firm, they can share their expertise. Advantage of mutual consultation. Since two people are collaborating and working together, they will have mutual consultation that will ultimately benefit the client. Lower workload. On each auditor, workload is going to get reduced. Quality of performance, quality of work is going to get increased, and service to the client is also going to get improved. So like that, various advantages are there because of the joint audit. That's why companies are voluntarily going and preferring for the joint audit. But the joint audit is not just coming up with advantages. Along with it, there are various disadvantages also. There are various disadvantages of the joint audit. What are the main disadvantages of the joint auditors? Problem of coordination. The joint auditors might not coordinate with each other. And one more main problem for the auditors is reduction in the fees. Reduction in fees. Last year for the Reliance Industries Limited, assume one audit firm only has acted as an auditor. They got an audit fees of 10 lakh rupees. Now in the current year, Reliance told, no, we will appoint joint auditors. We will appoint two firms. Now they are telling for each firm we will pay only 7 lakh rupees. Last year, since you have single-handedly done the audit, you got 10 lakh rupees of audit fees. Now you have to share your work with other person. Your fees also will get reduced. Lower fees. Superiority complexes, ego complexes will be there. Joint auditors might not coordinate with each other because of the ego complexes, and sometimes because of mistake done by one joint auditor, other joint auditor must also face the consequences. So like that, joint audit is coming up with advantages, not just advantages, the joint audit along with it, bringing the disadvantages also, but advantages are outnumbering the disadvantages. That's why some companies are voluntarily coming forward and getting their joint audits done. Now, sir, how the work will happen? When more than one auditor is appointed, how the work is going to happen? Do you think Reliance Industries Limited have appointed two firms as the auditors? Do you think each audit firm will do the audit separately? Will 2 times audit of Reliance is going to happen? That is not the purpose why joint audit is done. Similarly, SBI, if they have appointed 14 audit firms, does that mean each audit firm will do audit separately and 14 times audit of SBI is going to happen? No, that is not the purpose. So generally, when the joint auditors are appointed, the work will be divided among all the joint auditors on some suitable basis. If Reliance has appointed 2 audit firms for conducting their audit, these 2 audit firms will divide the work among themselves on different basis. If SBI has appointed 14 joint auditors, these 14 joint auditors will divide the work among themselves on some basis. You tell me on what basis work can be divided? The work can be divided on the basis of items of the financial statements. Like Reliance Industries Limited auditors are telling, one auditor is telling, I will look after incomes and assets. Other auditor is telling, I will look after liabilities and expenses. They can divide on the basis of period. On the basis of period of the financial statements, they can divide the work. One joint auditor is telling, I will look after first 6 months of data. Other joint auditor is telling, I will look after the next 6 months of the data. The work also can be divided on the basis of geographical locations. For example, Reliance Industries Limited is telling, I will look after some 10 states, and Reliance Industries Limited, one of the joint auditors is telling, I will look after 10 states, other joint auditor is telling, I will look after the remaining states. So like that, work can be divided on the basis of geographical location, and even work can be divided on the basis of identified units. Like Reliance is having multiple products, petroleum they have retail, they have fashion segment, they have telecommunication. So one joint auditor is telling, I will look after petroleum and retail, other joint auditor is telling, I will look after fashion and telecommunication. So like that, whenever joint auditors are appointed, generally the work will be divided among all the joint auditors on some suitable basis, and that basis could be on the basis of items of the financial statements, or that could be on the basis of period of the financial statements, that could be on the basis of geographical locations, or even that could be on the basis of identified business units. Now, okay, we have seen how the work is going to happen. Now, what about responsibility? There will be two kinds of responsibility. One is separate responsibility and other one is joint responsibility. See, since work has been divided among each of the joint auditors, each joint auditor will be held responsible only for the work which was allocated to him. Take for example, Reliance Industries Limited auditors have divided. Two auditors are there, A and B. A was allocated the work of first 6 months from April to September related data that will be verified by A. B is going to verify the next 6 months of data, October to March. Now, A will be held responsible only for the work which was allocated for him. B will be held responsible only for the work which was allocated for him. Like for example, if tomorrow it was found out that there was a fraud which has happened in the month of August, and these joint auditors were unable to identify. When the fraud has happened, August 2024 fraud happened, but auditors were not able to identify. Now you tell me, if this fraud was not identified, will both the joint auditors be punished or only one joint auditor will be punished? Only one joint auditor. Joint auditor A will be punished. Why? Because that period falls in the work of Mr. A. So like this, when work is divided among the joint auditors, each joint auditor will be held responsible only for the work which was allocated to him. He need not face the consequences for the work allocated to others. But however, standard also says one thing, there are certain areas where there will be joint and several responsibility. They have told a few areas. In those areas, if something wrong happens, every joint auditor has to face the consequences. Sir, what are those areas where there will be joint and combined responsibility? So if we have a look at that, so what are those areas where there will be joint and combined responsibility? Here is the list in respect of audit work which is not divided. If some work is not divided among any of the joint auditors, like for example, 14 joint auditors of SBI are there. So they have divided the work, but one area of work was not divided among any of the joint auditors. Like if I have to give you example once again, SBI 14 joint auditors are there. They have divided the work on the basis of different kinds of services which the SBI is offering. So one joint auditor is looking after housing loans. One joint auditor is looking after personal loans. One joint auditor is looking after vehicle loans. Like that, all the 14 joint auditors divided the work on the basis of business. Now, credit cards was not allocated to any of the joint auditors. Credit card was not allocated to anybody. It is an undivided work. If in the credit cards, if something wrong happens and if auditors were unable to identify, who will face consequences? All the joint auditors. Why? Because this is an undivided work. So first area where there will be joint and several responsibilities in respect of undivided work. Similarly, when decision has been taken by all the joint auditors collectively, some decision has been taken by all the joint auditors collectively, who has to face consequences if something goes wrong in that decision? All the joint auditors. Why? Because the decision was taken by all. If something goes wrong in that decision, everybody has to face the consequences. Similarly, in respect of matters brought to the notice of all the joint auditors, I will tell you one interesting thing here. Take for example, one of the joint auditor C, he was verifying vehicle loans, and while verifying vehicle loans, he found some misstatement. This misstatement, he did not keep it to himself. This all the 14 joint auditors, they have a WhatsApp group. They have what? WhatsApp group. In that WhatsApp group, whatever misstatement this person, Mr. C, has found out in the work which was allocated to him, he posted that message in the WhatsApp group. He posted that message. All the 14 joint auditors have seen it. Now, C did not take any action while making the opinion. He did not bring this point. He did not give modified opinion. Since he is not concerned, remaining 14 joint auditors also did not speak anything, and all of them collectively gave an unmodified opinion. Later, this misstatement came to the public notice. Now, who will be held responsible? Now, everybody will be held responsible. You will say, sir, it was work allocated only for C. No, C only should be held responsible. Okay, C should be held responsible, but C did not keep that information to himself. No, it was brought to the notice of all the joint auditors. If C is not taking action, since as a other joint auditor, you have that information, you should have taken the action. See, if you don't know and that's why you did not take action, okay, you will not be punished. But even after knowing also, if you did not take any action, then also you have to face the consequences. So if the matters has been brought to the notice of all the joint auditors and none of them has taken action regarding that, also everybody has to face the consequences. Similarly, whether presentation and disclosure of the financial statements is as per applicable financial reporting framework or not, checking that is also responsibility of all the joint auditors. Nothing but presentation of the financial statements, whether they are prepared as per Schedule 3, whether all the disclosure requirements of accounting standards are there or not. So checking this presentation is also everybody's responsibility. And in that presentation, if something has gone wrong and none of the joint auditor has taken any action, everybody will be held responsible. And finally, preparation of audit report that complies with the relevant statute. Nothing but preparing the audit report as per the standards on auditing is also responsibility of everybody. If audit report is not prepared as per standards, then who will face consequences? All the joint auditors are going to face the consequences. So this is what regarding responsibility. So two responsibilities, separate responsibility, joint responsibility. Generally, each joint auditor will be held responsible only for the work which was allocated to him. But there are certain areas where every joint auditor will be held responsible. 5 areas they have notified: undivided work, decisions taken by all, matters brought to the notice of all, and presentation and disclosure of the financial statements as per applicable financial reporting framework, and preparation of audit report as per relevant statute. In these 5 areas, there will be joint and combined responsibility. Now, sir, how the reporting is going to happen? How the reporting will happen in the case of the joint audit? In case of SBI, there are 14 joint auditors. Do you think each auditor will give separate report? Will there be 14 joint audit reports? No. In normal circumstances, what will happen is once the audit gets completed, all the 14 joint auditors will sit together. They will discuss all their findings and they will come to one common conclusion. They will form one single opinion. That opinion will be drafted in the audit report, which will be signed by all the 14 joint auditors. This is what normally will happen. So in the case of joint audit, all the joint auditors will sit together, discuss their findings, discuss their conclusions, and form one single opinion, which will be signed by all the joint auditors. This is what will normally happen. So if everybody comes to one common conclusion, fine. But when the problem will arise, when there is a disagreement between the joint auditors. Take a typical scenario. Out of this 14 joint auditors, 13 joint auditors are telling unmodified opinion is appropriate. But one joint auditor is telling he's a freshly qualified chartered accountant. He wants to use all his skill in his first audit only. This joint auditor, in the work whatever has allocated to him, he found misstatement. And it was not that material. So remaining 13 joint auditors are telling, okay boss, you found a misstatement, but that is not material. We will give unmodified. But this fellow is arguing, no, I found a misstatement. In my opinion, that is material only. I will give modified opinion. So 13 joint auditors are telling unmodified opinion. One joint auditor is telling I will give modified opinion. Now what should happen? Should this one person go with the majority? Should this one person go with the majority? The answer is no. There is no requirement to go by majority. There is no requirement to go by majority. Then what can be done, sir? Then what can be done is you need not go with the majority. In this case, what will happen is these 13 people will give a single audit report which contains the unmodified opinion signed by 13 joint auditors. This one person can express his separate opinion in a separate audit report signed by this one single joint auditor. There will be 2 reports here. So the thing is, in case if there is disagreement, no need to go with the majority. The disagreeing joint auditor can give his separate audit report through a separate opinion. Clear? So now there are 2 audit reports. Take this typical scenario. 2 audit reports are there. 13 joint auditors are giving unmodified. One joint auditor is giving modified. Which report will be circulated to shareholder? Both the reports will be circulated to shareholder. Which report shareholder should rely? That is his headache. That is his headache. Let him take that decision. So, but when there is more than one joint auditor's report, all the reports will be circulated. Let the shareholder himself decide. He will read the report, he will read the basis for opinion, and he will take the decision accordingly, which report should be relied, which report should be thrown away in the dustbin. So this is how reporting is going to happen. Clear, everybody? Next. And one more thing here, when there is more than one report, in each report that should contain a reference to the other report. Which means in this case, 13 joint auditors are giving a single audit report in which they are giving unmodified opinion. No, in their report they should mention that this is the audit report of us 13 joint auditors. There is one more audit report which is given by another joint auditor. Similarly, this person, while preparing his report, he should add a note in that report. This is my audit report. There is another report of remaining joint auditors. Like that, reference should be there. Clear? So this is what regarding reporting. This is the reporting responsibilities. And yeah, special considerations. One last part regarding SA 299. When joint audit is happening, what are the special considerations? Special considerations are nothing. In normal audit, one auditor will decide audit strategy, audit plan, audit program. But in the case of joint audit, all the joint auditors should be involved in planning. Everybody should participate in the engagement discussion. They have to develop one joint audit plan. They should have a joint audit strategy. On what basis they have divided the work, that should be documented, and that document should be signed by everybody. How they have formed the conclusion, what discussions they had, everything should be documented. So that's what they say here. Simply, whatever we do separately in a normal audit, that we do jointly in a joint audit. Like if you could see here, the engagement partner and other members of the engagement team from each joint auditor should be involved in planning. While developing the planning, while doing the audit planning, every joint auditor should involve. It is not like one joint auditor will develop and rest of them will follow. Everybody should involve. Members from every joint auditor should be involved in planning the audit. And they will establish one joint audit strategy which sets the scope and timing and direction of the entire audit. They will not have separate strategies. Everybody will develop one single audit strategy. And in developing the joint audit plan, in the joint audit plan, you have to include how the work was divided, what are your reporting objectives, factors that are significant, preliminary engagement activities, nature, timing, and extent of resources. You will find this familiar. Why? Because the same points we have discussed in the chapter audit strategy, planning, and program. If you remember audit strategy chapter, if you open the first question, you will find what factors are required to be considered while developing audit strategy. Same factors you will be able to find. But what they are telling here is, in case of normal audit, one auditor will do it. In case of joint audit, everybody, all the joint auditors will consider all these factors and establish a joint audit plan. Next, and they have to collectively assess risk of material misstatement, and they should document what procedures they are performing for separate areas, what procedures are performed for collective areas, undivided areas, who is going to do what. So like that, they have to document the nature, timing, and extent of audit procedures for common and specific allocated areas, and they should get one common engagement letter. There will not be separate engagement letters. Everybody will get one common engagement letter, and they will get common representation letters. Written representations also management will give collectively for all the joint auditors. They will not give separately written representation for each joint auditor. And finally, on what basis work was allocated, as I have told, that should be documented, and that work allocation document should be signed by all the joint auditors, and that work allocation document should be communicated even with those charged with governance. Nothing but, as I have told, whatever we do in normal audit, that only we will jointly and collectively do in the case of joint audit. That's it. So these are the special considerations as per SA 299. So with this, we are done with revising the chapter General Auditing Responsibilities, General Auditing Principles and Auditors Responsibilities, where we have covered 4 standards: SA 240, 250, 260 and 299. So with this, we have wound up the revision of this chapter as well.